Chapter 7, Day 1. So yesterday's focus in the video was basically over some new accounts, and Maria was mentioning how it's just a whole nother set of vocabulary, and she's absolutely right. So I'm going to go to a PowerPoint in a minute where we can recap the new accounts that you learned about during the last video. And specifically, the last lecture was focused on 4 types of transactions that all merchandisers have. And I think the best way for this to make sense to us is to picture yourself in your favorite merchandiser. So for me, that might be Target or the 99-cent store. For somebody else, it might be Home Depot. But actually picture yourself in the store. And if you visualize transactions as they occur and you ask yourself, how would the business record this? I think it'll make it a lot more meaningful and realistic for you. So when you watch the video, if you haven't yet done so, we talked about 4 types of sales. So again, I'm picturing myself in Target. And if I was sitting there watching the cashiers ring up these sales, I'd see 4 things going on. And this was the focus of the last lecture. We'd see sales for cash, although I don't see too many of those these days. We'd see some sales on account where the customer has an open account arrangement and they're to pay their account off every 30 days. Most of what I see these days when I'm watching, just observing what's going on while I'm in line at these retailers, most of the sales I see are sales with bank issued credit cards. Those are Visa and MasterCard. So if you were to take a credit card out of your wallet, and it has a bank's name on it, like Chase Visa or Bank of America MasterCard or Wells Fargo Visa. Those are what we call bank issued credit cards. And what that means is the company gets the cash within 24 hours. So it's actually recorded as a cash sale, but the bank takes their 3%, and the book will give you the figure to use, but it's usually around 3% fee right off the top. And what you heard me say in the last lecture, what most people don't realize is the way that these credit card companies get so rich is not just by them charging us, the consumers, these outrageous interest rates on any unpaid balances, but it's every time you use your credit card at a retailer like a Target or a 99-cent store, they get 3% right off the top of that sale. And not only the sale, but the sale with the tax. So we'll refresh our memory on how to record those. And then there's also non-bank credit cards. Those would be things like American Express. You notice there's no bank name attached to that. It would be things like Diners Club or Discover Card. And those are not cash sales. Those are sales on account because it can take up to 2 weeks, especially with American Express, to get the funds in. There's usually a higher rate that's charged. And so we'll take a look at how that's recorded. That's what we covered last time, kind of looking back. And I want to take a look at a quick PowerPoint for Chapter 7. Again, you guys have all the PowerPoints in your modules link. I'm just picking out a few slides to go over as a recap of where we've been before we start the new part for today, which is going to be the Accounts Receivable Subsidiary Ledger, something I'm hoping that you read about. Does anybody have any questions so far? Okay, here's these new accounts that we were talking about before class started. There were 5 of them. Okay, so remember, when we talk about these new accounts, I would encourage you guys to keep a running list in your notebook. And I would write down 3 things about every account you learn. 2 out of the 3 are here. So I would list the type of account, I would list the normal balance, and I would list which financial statement it goes on. Because you're always given multiple choice test questions or short problems, kind of fill-ins on the test about that information. So basically, the new major revenue account that we're using for the rest of the semester is called sales. So sales, no matter which of these companies you picture yourself in, that's the source of their revenues. So whether it's the 99-cent store, whether it's Home Depot, whether it's Vons grocery store, the vast majority of their revenue is going to be in this sales account. So we introduced that last time. It has a normal credit balance and it would be on the income statement. We also learned that in a state like California, you're likely to have sales tax. And we explained that last time. Sales tax is not something that anybody likes to pay, but it's a way for the states to earn revenue to help support the operations of the state. And it's a liability account. Can you guys do me a favor and make sure that you're muted unless you guys have a question? Because I do hear a lot of background noise and I don't want to have to leave my area to go mute somebody. Okay, so sales tax payable is a liability account. It represents the tax that is charged to the customer. You and I, the end users, are the ones that pay the sales tax. And so the companies that we're talking about are what we call a conduit. It means that they collect it from us and then turn around and pay the state. That's why this is a liability account. It's not an expense. It's not an expense to the company. It's a liability account. They're collecting it from us, the customers, and the company turns around and pays it to the State Board of Equalization. We also learned about a new account called sales discounts. We're going to see that used today. Sales discounts, again, from the last lecture, are notated with these funky looking fractions. For example, I'm writing one on the screen right now. So 110 net 30 means that this company is offering a prompt payment discount of 1% if you pay your bill early within 10 days. Otherwise, if you don't want to take advantage of that 1% discount, then the whole thing's due in 30. So if a company can pay its bill early, this is the account that's used to record that 1% discount. It is a contra revenue, and we know what a contra account is now. We've had a couple of them. A contra revenue is an account that's contrary to the normal balance. So a contra revenue account is going to have a debit balance, and that account is used to track early payment discounts. Okay, and then a fourth new account that you guys can relate to as a consumer. I know that almost everybody in this room and everybody watching the scheduled lecture has returned something at one point or another. You didn't like the way it fit, or it had a defect, or whatever you bought stopped working. Well, companies want to account for that in its own separate account, because when customers return things, it's very expensive. And so we want to track what's being returned so that we can start looking at our inventory and seeing, is there some kind of an inferior product that we shouldn't be buying? So that's called sales returns and allowances. It's also a contra revenue. So because of that, it has a debit balance and it tracks the returns made. And by the way, I'm going to put an X out by 3 of these accounts. These 3 X's, when you net them together, it's going to give you the first large chunk of what we call net sales. So I'm going to put X equals net sales. So for Target, for example, I like to shop at Target. Darn it, excuse me while I get my pencil. At Target, if you were to look at Target sales and you were to subtract out any kind of discounts they offered, and you were to subtract out the sales returns and allowances, that would give you this net sales. And that's one of the goals of this chapter, is the ability to calculate the first large chunk on an income statement. So you haven't seen an income statement yet for a merchandiser. We're going to go from this very easy income statement that we learned in the first 6 chapters, right? If you think back about that income statement, it was just the fees income less a few expenses and you got net income. Well, merchandisers have much more sophisticated transactions. You'll notice that just by looking at 5 new accounts, several of them are contra accounts. And so the first big chunk of what we call a multi-step income statement, multi means many, so a many-step income statement, is going to be your ability to calculate this amount called net sales. So as we look at this new vocabulary, this list of 5 accounts, 5 brand new accounts that we're using, I wanted to also throw in there that the sum of those X's, those 3 accounts, are how we're going to calculate net sales. And what that literally means, think about your paychecks, because all of you have probably earned a paycheck or you live with somebody that earns a paycheck. And when I think of my check, my net pay, that literally means my pay after deductions. That's my net pay. If you guys get a paycheck, your net pay is what goes into your account. It's the amount that you're left to take home after your taxes and deductions have been taken out. So that word net means after deductions. So what we're calculating, the income statement component in this chapter, means sales after the deductions. Here's the 2 deductions. And then the last account that was explained in the lecture last time was this credit card expense, and it relates to that 3%. It's approximately 3% charge that merchandisers incur when they allow their customers to use a credit card. Okay, so again, this was all explained in the last lecture. So right now I'm spending probably about 15 minutes or so kind of recapping where we've been. And then we'll start with the new stuff. So let me stop talking for a second. Does anybody have any questions about any 5 of those accounts that maybe you encountered on the homework? And again, we mentioned that it does take practice. You may not have had a chance to practice, but that's why I want you guys starting the homework early. Anybody have any questions? Okay, so again, a review of where we've been. We learned, again, 4 different types of sales. And I'm just going to flash them up here because they're all explained in the video from last time. 4, there were cash sales. That's what you see here. The debit to cash, and then the revenue in the sales account and the sales tax. And then we had sales on account, where the company needs to collect after about 30 days, and we used accounts receivable. And then I think probably the most difficult sale that we did in this chapter was credit card sales. And that's because of that 3% fee. So again, kind of as a refresher as to what I hope you already watched prior to today or read prior to today, there was a sale of $900. There was an 8% sales tax. That means the amount subject to that fee is the sum of the sales plus the tax. So the 2 of those together was $972. The bank took their 3% fee out, which means the company wound up getting the rest of it, the other 97% of it. And let me show you what that journal looks like, that journal entry looks like. Here's the debit to cash. Here's the debit to the credit card expense. The sales account, which records the revenue, and the sales tax payable, that's recorded the same way. The sales and the sales tax payable doesn't change, and I hope you noticed that in the lecture. What changes is how the debit is accounted for. On a cash sale, it was just a straight up debit to cash. On a sale on account, it was a straight up debit to accounts receivable. On a bank credit card, that's what you see here. It had to be split between the cash, which was the 97%, and the 3% fee that the credit card company collected, if that's the percentage they used on that exercise. And then the 4th type of sale was the non-bank credit card, the American Express. Okay, you'll notice that there wasn't any cash when that sale occurred. Instead, American Express says, I'll pay you when I get around to it, usually about 2 weeks later, and their fee is usually higher. And so that was the focus of yesterday's lecture. Even though we didn't come into the classroom live, I did send it to you. So today what we're going to focus on is the use of a subsidiary ledger. We're going to focus on that sales discount. And while we're looking at these PowerPoints, here's the net sales calculation that I just spoke about. This is the first, what I call chunk, and you guys are going to hear, unfortunately, the gardeners in the background. This is the first chunk of a multi-step income statement. And what this literally means, think about your paycheck. is sales after the deductions have been taken out. So this company had 25,700 in sales, but two things pulled it down: a $600 return, and then discounts that they gave their customers of $100. That pulled their net sales down to 25,000. That will be the first chunk of this very large income statement that I won't even show you today because it will be too overwhelming. I'll probably show you the income statement that we're working towards next time, but it's in chapter 13 of your book if anybody wants to look ahead and go take a look at it. So questions on those 4 different types of sales or anything that threw you for a loop? Okay, then what we're going to talk about today, I'm going to go back to that agenda. What we're going to talk about today is the second half of chapter 7 and the first half of chapter 8. So I'm going to refresh your memory. We did talk in the last lecture, in the last recorded lecture, we did talk about what trade discounts are, but I'm going to start off today by demonstrating another bi-level trade discount. And you guys probably are not old enough to remember, but it used to be that these big stores would print out catalogs, right? This was before internet connectivity and internet sales became a big thing. And so I think of Staples or Office Depot also. They used to have 3 catalogs that they would send out. You and I, students, right, we would just pay list price. But a small business owner that maybe bought $10,000 worth of office supplies a year, they would get another catalog that would show discounted prices. And the super big users like Cerritos College would get another catalog that had even cheaper prices. Well, it got to be way too expensive, and internet pricing changes now daily. So to account for that, trade discounts are volume-based discounts. We're going to jump in and do one more example of that today. You already saw the computation of net sales, so we'll work on that a little bit. But the major part that we're going to cover today is accounts receivable and this thing called the Accounts Receivable Subsidiary Ledger. And this is the first subsidiary ledger that we will cover. So right off the bat, while we're taking a look at this agenda and talking about some big new words, subsidiary is a fancy word for part. So a subsidiary ledger keeps the different parts for the whole controlling account called accounts receivable. Okay, let me try and explain it another way that maybe you guys can relate to a little bit better. Most of us have eaten at a Taco Bell, right? And most of us have probably eaten at KFC. Did you know that they're owned by the same company? It's a company called Yum, Y-U-M, Yum Brands. So KFC keeps their own set of books and Taco Bell keeps their own set of books, but they're subsidiaries, they're part of a larger conglomeration or controlling company called Yum Brands. So this is a very fancy word for part. And what this is going to do is it's going to track individual balances within our whole accounts receivable. So we're going to talk about why it's necessary, how to do the posting, and this new thing called the Schedule of Accounts Receivable. That's going to be our goal for today, for chapter 2. I think the book does a pretty good job, and I don't often say that, but I think the book does a pretty good job on this topic. In fact, I think I'd opened up the pages of of the book. So you guys have this in your book. It's on page 211. I just want to show you what an accounts receivable subsidiary ledger would look like. And then we'll actually jump in and we'll do one of these, get our hands dirty. But on the screen here, and you guys have this on page 211 of your book, you guys will see 3 different transactions all out of this chapter. So just glancing at these transactions, this first transaction was a sale on account. Okay, I know that because they debited accounts receivable. Whoops, what did I just do? The second transaction looks like there was a return. So our customer decided to return some goods to us. And then the third transaction looks like she paid off her balance. So here's what the Accounts Receivable Subsidiary Ledger is doing. Remember that we have this big major account called Accounts Receivable. That hasn't changed. It's an account in the general ledger. It's an asset account. It goes up when we sell things on account, and it goes down when people pay us off or there's some type of a return. The new part to this is now that we have customers buying things where we may have to send them statements, we need to keep track of each individual customer's balance. And this little brown looking thing is what we call the Accounts Receivable Subsidiary Ledger. I want you to think of it like this. Most of us have a credit card. If you don't, we'll talk in chapter 9 about why you need to get a credit card. But most of us have a credit card. So how do you know how much you owe your credit card company? Well, if we had really good accounting records, we could track it by ourselves. Every time we bought something using our Visa, we would write it down. And each time we paid something, we'd write it down. But most of us, the vast majority of us, wait until we get our Visa statement. And what that statement shows is everything you purchased, any payments you have made, and that's how you know how much you owe the Visa company. Okay, well, that's the same thing happening here from a retail perspective. If you guys called your Visa company up and you asked them a question, maybe like, can you tell me what my balance is today? You would not expect them to say, well, I don't know. What do you think it is? You would expect an exact answer. And the way that they keep track of that looks something like this. Each one of us, if you think about that Visa card, they have an Accounts Receivable Subsidiary card for each one of us. Let's say that all of us were a Visa card holder. These would be kept in alphabetical order. There would be one for each customer. And on this one for on N, they are showing how much she owes. So if Anne calls in at any given date, if she calls in on January 8th and says, what's my balance? You could tell her, oh, it's 648. If she calls back on January 20th or 21st and says, what's my balance? You could look at the activity that happened. Here's her, the sale that we made to her on account. Here's the return. You can see that 216 reducing her balance. And this balance is keeping a running track of what she owes each and every time. And then you can see that she made a payment against that. Now her balance is zero. So this is a part of the bigger accounts receivable picture. So what you're going to see on these postings here is something you haven't seen before. It's that little check mark. And that little check mark means not only have we updated accounts receivable in the general ledger like we've done for 6 chapters now, in addition to that, we've also went and updated a specific customer's card. In other words, her card here is part of the bigger accounts receivable balance. So here's what it would look like, just using T accounts. Here's accounts receivable. This is what we call a controlling account. That hasn't changed except for the word controlling. And so we have all of these balances going in and going out. This is an asset account. We know that it's increased when people owe us money because we've sold them a good or a service, and it's decreased mainly for payments. It would also be decreased from returns. And at any given point in time, there's going to be a balance in that account. So I'm totally making up this number right now. Let's just say the balance in there is 1,000. What's going to happen now is that balance is now going to be supported by the parts, by the subsidiary ledgers. So company A, let me put some little ledgers up here. Company A might owe us 200, and company B might owe us 300, and company C might owe us 100. Let's see, 3, 4, 5, 6. That means this last company would owe us 400. At any given point in time, that controlling balance is supported by these individual customer cards where we're keeping a running tab of what those customers owe us. And just like Visa sends you out a statement once a month, could be electronically or it could be through the mail, companies can use these subsidiary cards to send out statements showing exactly what each customer shows us. Because if you don't send out the statements, you're not going to be getting in the money. And think what would happen if your paycheck was delayed by 2 to 3 weeks. I don't know about you guys, but if my paycheck was delayed 2 to 3 weeks, that would cause some cash flow problems for me. And the same thing with these companies. If these customers aren't paying their money to them in the 30 days that they give them to pay, that creates liquidity issues. Because just like you guys, if you didn't get money in as you were expecting, you may have trouble paying the rent and paying your electricity bill and paying your cell phone bills. Companies too. If they can't get the money that's owed to them in a timely manner, they're going to run into cash flow problems. So that's why we have these accounts receivable subsidiary ledgers. And that was the major new part for today. So if I go back to your book demonstration, a subsidiary card is kept for each individual customer. And anytime accounts receivable is used from this day forward, this accounts receivable, it's not going to let me write on here. Anytime accounts receivable is used from here on out, there's going to be 2 postings. That's what that check mark means. Once to the general ledger, just like you've done all along. And the new part is the company's customer card needs to also be updated. So at any given point in time, if Ann calls in or some other customer calls in, we can answer intelligently about her balance or answer any questions she may have. So any questions on how that controlling subsidiary relationship works? We're going to jump in and try one, but any questions so far? Okay, then the last thing I want to show you is what happens at the end of the month. Remember, every customer has one of these subsidiary accounts set up. So then what happens at the end of the month, usually on the last day, but it could be anytime they want to do it, they take the balance in every account. So here, Roy Anderson, if you go to the bottom here, he owes us $702. And Ann, she doesn't owe us anything. She's paid off her balance. We're going to create a schedule. And the purpose of this schedule is to make sure that the sum of the parts, all these brown boxes here, the sum of the parts equals the whole accounts receivable. So you look at these balances and you go in and you do a schedule, and you're going to see that here. So Roy Anderson owes us $702. Ann owes us nothing. Vicki Bauman owes us nothing. Linda Carter owes us $54. This balance, $756, must match what's in the controlling account for accounts receivable. There's always a check and balance feature in accounting. So because we have these subsidiary accounts, there's one more level of detail that has to take place. Posting to these subsidiary accounts and then showing a final schedule of accounts receivable at the end. We're going to get our hands dirty in just a minute and try one of these. But does anybody have any questions about what you've seen so far? Okay, let's jump in and try a couple of these. So we're going to start off with, if you guys have opened your Excel files for, this is Chapter 7, Day 2. And the first one I've already demonstrated in the last lecture, so I'm going to pass on that one. I'm going to go to one that's similar but a little bit more difficult. I'm going to go to the second tab, which is exercise 7-7, and this says a series of trade discounts. And this goes back to the example that I was talking about earlier, where they don't create now 3 levels of catalogs. Instead, they give different users different percents off, what the book will call a trade discount. So first thing I want to get into your notes, these are volume based. So somebody, a student would pay list price if you were to walk into Staples. A small business user might get something like 20% off. And a super user like Cerritos College that probably spends close to $500,000 on office supplies, they're going to get these bi-level discounts. They're going to be given 2 levels of discounts. So this was also described in the last lecture, but because it causes problems with students, I wanted to personally go over with at least one example with you before we went on. So I'm going to do number 1 here. So again, this is a trade discount, volume-based, and what it says is the list price of these supplies are $7,000, but because we're a super user, they give us 2 discounts, 35% and 10%. Now, some people on a test are going to look at that and they're going to say, oh, there's a 45% discount. That's not what it says. It says that first take 35% off the list. And then after we get the net amount of that, then you can take the second 10%. It's not 45% off the top. It's 35% off the list and then an additional 10% off the net. Let's just do one and get rid of the complicated words. So the list price on that first one is $7,000. And that first discount is 35%. So we're going to calculate that first. I'm going to show my work. 7,000 times 35%. I'm going to let the computer do that. 7,000 times 35%. There's the first discount. And so now I'm going to take the net or the difference of $45.50. Let me wait for a second while you compute that. And that's where you apply that second discount. The mistake I'll see students make is they'll take 10% off the 7,000, and that's not what you do. That second discount for the big mega users are taken off this net. So my second discount is not 7,000 times 10%. It's $45.50 times 10%. And let's go ahead and calculate that. $45.50 times 10% will be another $455. And so the final cost or the final price, depending on what side of the house you're on, is $4,095. Okay, let me give you guys a chance to look at that. And how that would be recorded if we were the seller, because this whole chapter is about the sales side of the house. If we were the seller, the way that that would be recorded, if it's on account, and typically they are, the journal entry would be Accounts Receivable, and whatever the name of the customer is, and then a credit just to sales for the full discounted amount, $4,095. There is not a special account to track those discounts in. The sales is recorded at the net amount. Okay, so I wanted to go over that one more time because I do see people making mistakes on the homework, and I did have a couple of emails yesterday about that. So I wanted to make sure we took some class time to talk about these, what we call bi-level, bi means 2, bi-level discounts. Any questions? That's not to be confused with a sales discount. A sales discount is for prompt payment. We're going to see one of those next. Trade discounts are volume-based, and they're not tracked in any special kind of account. Company can choose to do that, but for our purposes, the sale is just recorded at the net amount. Right, so if you or I were to walk in to Staples, we'd pay $7,000. if a small business user like myself, I'd probably get a small discount. I might be paying this. A mega user like Cerritos College is going to get the cheapest, most discounted price because they're a heavy user and they do a lot of volume through this company. And I think I might have mentioned this in the last lecture. I think Cerritos College pays about 50% of what you and I would pay for their office supplies. Okay, then let's go talk about a sales discount. So I didn't want to leave here today without giving you an example of what a sales discount is. And if you hear me laughing when I read these problems, Mr. Farina, one of the authors of your book, is a colleague of ours, a very close friend of mine as well. He thought it would be funny in these next few chapters to use teachers' names in these problems. So if you hear me laughing, it's because Mr. Maloney says Maloney's Musical Instruments. He's a professor at Cerritos College, and Mr. Franke is my office mate, Franke's Flute. So I laugh when I read these. He uses mine and my children's name in other problems as well. So it says on April 1st, Maloney Musical Instruments sold merchandise on account to Franke's Flutes for $7,000. Here's what we want to look at. Here's what this one deals with. Terms of 210 net 30. Okay, that means if Franke can pay this off within 10 days, he's offering a 2% discount. Otherwise, if he can't, the whole thing's due in 30 days. And then it says payment was received in full from Franke's Flutes on April 10th. And they want you to record both journal entries. Okay, so first journal entry, this is what the last chapter was about, or the last lecture was about. We would debit accounts receivable, and because we're now keeping subsidiary ledgers, we have to list the customer's name always, always, always. So you won't see us using accounts receivable by itself anymore. It'll always be followed by the customer's name. So this one happens to be Franke's Flutes. That sale was made on account for $7,000. So we'll use this new revenue account that we learned about last time called sales. And then a brief description of what happened on that transaction would include any kind of source document. So this is invoice 1001. And the terms were 210 net 30. So when the sale's made, you don't know whether the customer is going to be able to take that 2% discount or not. So you record the sale at the full amount. Okay, 10 days later, it's actually 9 days later. Remember, they would have to make that payment within 10 days to take advantage of that 2% discount. Well, they do. They make it 9 days later on 4/10. And so here's where the new account, that new contra account comes in. So what's this going to look like? Well, we're going to get cash, but in addition to the cash, we're giving them a sales discount. And of course, I have to get rid of the whole accounts receivable because it's being paid off. So this is what I call the shell of the journal entry. We need to fill in the amounts. So let me go get rid of the accounts receivable. That's going to be the easiest for me, 7,000. The sales discount was 2%. Where that came from was that funky looking fraction here that I'm circling. 2% discount if paid within 10 days. So this discount is going to be 2% of the 7,000. I'm going to let my computer do that. 7,000 times 2% would be 140. And so to get the cash, you can do that one of two ways. I'm going to show you both. You could take 7,000 minus 14. That would do it. Or since the discount was 2%, the cash is going to be 98%, right? The 2% discount is what they don't have to pay because they're making a prompt payment. You gave them an incentive. Maloney gave them incentive to pay early. They could save $140. So there's two ways you can calculate the cash. You can just take the difference between these two. Or if you gave them a 2% cash discount, you could take 7,000 times 98% and get the same answer, however you prefer to do it. But in any case, what I wanted to show you is this new contra account, contra revenue account. It's used to track prompt payment discounts. And because companies want their cash coming in sooner, oftentimes they're willing to give up a little bit of a discount to get their cash in. So the last thing I want to show you before I go on to the next one, I want to show you, if this were our only transaction for the company, I want to show you how the chunk on the income statement called net sales, I want to show you what that would look like. So first, I'm going to use the word chunk. You won't find that word in your book. It's my slang. The first chunk of the income statement is called net sales. So because I know this is on your test, if I were to say this is the only transaction, do an income statement. Well, the only revenue accounts we have on here are sales and the sales discounts. So this is what net sales would look like on your income statement. You would see revenue from sales as a heading. And right below that, you would see the sales of 7,000. That's the orange one. Let me make that orange so you can see it. And then remember what we're headed towards, net sales. Think about your paycheck. Your net paycheck is what you get after deductions. Net sales is the sales after the deductions. So you would see two things here typically. You would see less sales returns and allowances, which we didn't have any of those. And right below that, you'd see less sales discounts. So we didn't have any sales returns and allowances on this one. We did have 140 in sales discounts. And so our last line, the first chunk of our income statement, would show the net sales, literally meaning sales after deductions. It'd be 7,000 minus that 140. That would be the first chunk of your income statement. So I want to make sure that we get that into your notes a couple times so that when that little 4-point test question comes up and says compute net sales, it won't be the first time that you've seen that. Our goal is we're working towards this big, massive income statement. It's called multi-step, and we're going to learn it in chunks as we go. The Chapter 7 chunk on sales, this is the part we want to be familiar with on the income statement. Any questions? You guys are quiet today. Okay. If I don't hear any questions, let's move on and take a look at how that subsidiary ledger works. We went over what it looks like in a book, but reading about it and getting your hands dirty are two different things. So the next one, 7-9 on your screen, the next one we're going to do is an accounts receivable subsidiary ledger. Remember what subsidiary means. It means part of a whole. And so I wanted to do at least one example with you to give you some hands-on practice, and then of course to answer any questions you may have. This isn't replacing any kind of the posting that we've done previously. All that still happens like normal. This is in addition to. And again, the Chapter 8 on the buying side is going to piggyback off of this. So we got to make sure that we get this down in Chapter 7 for the sales side, because the buying side is going to be very similar. So we're going to read this together, and we're looking at exercise 7-9. And what it tells us to do, post the entries in the general journal below to the accounts receivable account. So the only postings they're interested in is the ones that affect accounts receivable. And to start with, they tell you that there are existing balances. Here's the controlling account. This is how much is sitting in accounts receivable, 10,840, and it's made up of 3 customers that each owe us money. These are what we call the subsidiary accounts or parts. And so anytime we touch accounts receivable, we got to go update 2 things: the controlling account as well as the customer's card or the customer's accounts receivable subsidiary ledger. So I started this off for us. They gave us this yellow part in the book. And then what I did is I created some subsidiary ledgers and this controlling total up here. And what you see that I've done is I've entered these balances in there. Now, these are usually in alphabetical order. Excuse me. I wrote or sent an email to my friend, one of the authors, and said, I don't know what kind of order you have these in, but definitely not alphabetical. So these are typically in alphabetical order. We have 3 customers: William Hall, Jim Garcia, and June Lean. So you'll see these 3 balances in these ledgers down here. And at all times, the sum of the parts has to equal the whole. So before we even start this problem, on your calculator, just verify for yourself that the sum of those 3 customers, 6,400, 2,260, and 2,180, just verify for yourself right now that that's what's making up this controlling balance. They gave us that data. What they want us to do, once you verify that, they want us to post 2 transactions that affected accounts receivable. And it looks like there was a partial payment here when I look at the description. And then it looks like there was a credit memo for a return made. Our goal is to post these to the 2 places. When you see accounts receivable from here on out, there will be 2 required postings. One to the subsidiary ledger, one to the controlling account, accounts receivable, like you've always done. And the second new one is going to be to find this person's card, William Hall's card, and do a second posting. And at the end, we'll have to balance it out. We'll have to show that the sum of the parts equals the whole. Okay, so the only part they're concerned about is accounts receivable. So let's go post this first one. It says that they credited accounts receivable because William Hall made a payment of $640. Okay, we're going to go post that. We're going to post it 2 places. First, to this controlling account. So I'm going to type in $640. I'm going to put a space first that was payment on January 8th. Okay, now I'm going to make this yellow. And the reason I'm going to make this yellow is to warn you that anytime you touch a controlling account, you must go update the parts too. You must go update the subsidiary account. So I'm only partially done with this. I'm only partially done with posting to accounts receivable. Because I've done that posting, I'm going to go put the accounts receivable account number in. And I'm not sure that they told us what account number it was, so I'll probably make one up. If you guys see an account number, let me know. I don't. So I'm going to make the account number up. I'm going to say accounts receivable is 111. You guys are used to doing that. Here's the new part. The second post I have to do is I have to go put that on William Hall's subsidiary ledger. So here's his subsidiary ledger. I'm going to drop my date in, which is January 8th. And I'm going to put that there was a credit to accounts payable of 640 made. And so what I have to do now is update his balance. Again, if you think about this as a big T, credits pull the customer balance down. If he makes a payment, he doesn't owe us $6,400 anymore. What he does owe us is the difference between these 2. So he did owe us $6,400. Now that he's made a payment, that's going to bring that balance down. So do that on your calculator, or you can use Excel. He now owes us $5,760. Okay, let me stop, make sure we understand how we got that. And I need to do one more thing. I need to cross-reference this posting. So let me go see what page of the journal this was. Hopefully they tell us. This was the journal, page 40. So I'm going to come down here, and for my post reference, I'm going to put J40. Ooh, that's hard to see. Let me make that bigger. J40. And then up here, the way that I'm going to show that we've updated his account, I'm going to put a slash mark and a check. Okay, so this has been posted 2 places. Anything that touches AR now will be posted 2 places. To the accounts receivable controlling account, like we've always done. The new part is to an updated subsidiary ledger. The purpose of the subsidiary ledger is to keep track of all the individual balances that our customer owes us for 2 reasons. So that we can answer phone calls if they have a question about their bill, and also so we can have a source document to make a statement to send them out, kind of like Visa sends you guys statements each month if you have a credit card. Now I got one more to go, but any questions right now on that posting? Okay, let's do this second one. If I look at this, this was a return that one of our customers made, because the description says we accepted a return of defective merchandise. We had to give them back the sales tax, which we talked about in the last lecture. So here's our goal. Our goal is to look at this accounts receivable transaction. That's all we're going to focus on. And there's 2 postings. One to the general ledger. So they credited accounts receivable here for $216. And the reason they did that, that was a return on 1/20. So I'm partially done. I'm going to go in there and put my account number down because I have updated my controlling account. But if I touch the yellow area, then I also have to go update a customer's card. How come? The sum of the parts have to always equal the whole. So I'm going to go find Jim Garcia's card. I'm going to scroll down. I'm going to find Jim Garcia's card. There it is. I'm going to drop in my date, which I can't remember. I think it was the 20th. So space 120. I'm going to come over here and put that credit in of 216. You might want to put a memo. You don't have to, but you may want to put something in the description column that that was a credit memo, or maybe that it was a return. You don't have to do that. Most importantly, what did that do to this balance that he owes us? It brought it down. Credits to accounts receivable or to any other asset bring the balance down. So he doesn't owe me $22.60 now. He owes me the difference. Give me a second to calculate it. He owes me now $2,044. Now I can go up above and cross-reference, put my post reference in. This came from the journal, page 40. And back up on my journal, I'm going to show that not only did I update the controlling account, that's what that account number is for, but the check mark indicates that I've updated the subsidiary ledger. And you might want to write that in for your notes. A check mark equals an update to the subsidiary ledger. So I got to do one more thing. I need to prove now, once you got a bunch of posting going on, you got to prove that the sum of the parts equal the whole. What the heck does that mean? I need to do now a schedule of accounts receivable showing that when I add up those 3 customer accounts, they balance back to this control total here. That's been updated. So if I scroll down, I think anyways, The next exercise says, okay, you've made these postings, prepare a schedule of accounts receivable. In other words, prove, I'm going to write that down in my own words, prove that the sum of the parts equals the whole. That's what we're going to do. So how do you do it? You go in and you list each balance that is owed to you. So I started it off by just giving you this blank little form. So I have 3 customers that I'm going to put in here. First one was William Hall. Okay, I need to put in the balance he owed us. Okay, now again, you guys know that I have a disability that causes me to transpose a lot of numbers. So rather than typing it in, I'm going to go grab it. You guys can grab it. The way you can grab it is press equals. I'm going to press my equal sign, and I'm going to go click on his balance up here. Just click and press enter. Okay, there's his balance, William Hall. Of course, you can just manually enter it in also. Jim Garcia is my second customer. I'm going to go grab his balance from his card. And my last customer, I think it's my last one, is June Lean. I'm going to go grab her balance. So this is basically a list of customers who owe us money. And to show that the sum of the parts equal the whole, that's what we're doing in my words, not trying to use all the sophisticated words that the book uses. To prove that the sum of the parts equals the whole, I'm going to total this up. So I'm just going to write total. And I'm going to go in and let Excel, using an equal sum that up. Now, what you better see, and I'll highlight this, that balance right there has to balance that controlling total in accounts receivable. So I'm going to scroll up and make sure that it does. And in fact, I'm going to see if I can get this on one page so you guys can see it. I hope it's not too small. Maybe I'll move this down a little bit. Give me 1 second to move this so you can see it all on one screen. Knocked off my balance. Well, I don't know if I can fit on one screen without making you guys wait, but here's the control total. And here is the schedule on my accounts receivable, has to balance to that control account. We just proved that the sum of the parts equals the whole. Now, anyone that's in the classroom or watching at home and you're interested in obtaining immediate job skills, think about taking the QuickBooks class. In the QuickBooks class, all of this is built into a module. And every time you create an invoice, it automatically adds it to the schedule of accounts receivable. And anytime you record a payment being received, it automatically deducts it. If anyone in here is looking for automatic job skills, I strongly encourage you guys to take the QuickBooks class. I know that the fall schedule's open. You would want to look for Accounting 60. If you're just interested in learning about the basics of QuickBooks, I would encourage you to take that class. If you're thinking about a career path where you can make decent money, Accounting 160 is an 18-week class. So it's also QuickBooks, but it's 18 weeks. And by the end of that class, you can choose to take a QuickBooks certification exam. And last I knew, I don't think this has changed, the school had money to pay for that exam. It's usually a few $100s. The school had grant money so that if you took that class and you were interested in becoming QuickBooks certified, which I can't tell you, I get emails every week from people looking for a bookkeeper, somebody that's QuickBooks certified. So I don't even have to go out looking for customers. The customers are sent to me. Once you have that certification, they'll send customers your way. But that might be a job skill that you might want to think about acquiring. If you guys have any questions on that, I'd be happy to answer them either in class or definitely in my office as well. questions about that subsidiary controlling relationship?
Yes, Professor, I have a question. In the third one, the June lien account, that one, since there was no activity, we just pass it on?
So there wasn't any activity during this current time, but she did have a beginning balance, so we would have to include that on our schedule. So if we didn't include it on the schedule, we would not balance. But you're right, she didn't have any activity during this month, but her balance doesn't go away. It just stays the same. So you would want to carry that balance over.
Thank you.
You're welcome. Good question. Anybody else? Okay, then we're going to do a little bit more practice before we wrap up chapter 7. So let's go to 7-6B. This would be an example of a 10-point test question. So if you guys have looked ahead, you'll notice that on our next test, you have a 10-point problem on the sales side, and you have a 10-point problem on the buying side out of chapter 8. So something like this would be what I expect you to do for 10 points on the next test. Because this one's pretty long, and this is the second day of chapter 7, we'll go ahead and do the first 3 or 4 transactions. And then what I'm going to tell you to do is to go home and finish this, and I'll send you out the solution so you can check yourself later. So what I did right before class, I went and snipped these first 3 or 4 transactions and copied them over to our worksheet. You guys can go back and forth looking, but in a classroom where I'm trying to hold your attention, it drives students crazy going back and forth. So I snipped the first few, and we'll carry it over to our next worksheet. So let's read through this. It says the Old English China Shop sells china, stemware, and other gift items. Keep me out of there. I'm a klutz, and I'd probably break half the things. Sales to retail customers are subject to an 8% tax. I'm going to circle that. We got a state that has an 8% sales tax. The firm sells its merchandise for cash to customers using bank credit cards, such as MasterCard and Visa, and to customers using American Express. That's a non-bank credit card. One gives you cash right up front, one does not. The bank credit card charges 3%. American Express charges 4%. Those are typical fees. The Old English China Shop also grants trade discounts. Okay, those are volume-based. We just talked about that. To certain wholesale customers who place large orders. These orders are not subject to sales tax. That's because those wholesalers turn around and sell them. Remember, only the end user pays the sales tax. And they give us a bunch of transactions. So what I did again is I snipped a few and carried it over to our worksheet here. So we're going to do a couple of these together, and then I want you guys to try and finish this up at home, and I'll send you out the solution today as a wrap up of chapter 7. Okay, so first one, unless you guys have questions. Okay. June 1st, sold crystal goods to Sonoma Country Kitchen, a wholesale customer. Okay, stop. What the heck does that mean? A wholesale customer is someone who's going to buy a large amount of stuff and turn around and resell it to somebody else. So just with that first sentence, there's no sales tax involved because only the end user pays the sales tax, right? And because it's a wholesale customer, chances are they buy in big volume. There may be trade discounts. So let's keep reading. It says the list price is $9,000. That's what you and I would pay, but they give a 20% trade discount. The sale is not subject to sales tax. They issued an invoice with terms of N15. Okay, what that means is this is a sale on account. How do I know that? That N15 means they need to pay this within 15 days. No discounts, no sales discounts are offered in terms of prompt payment. So we got to record this. So I'm going to drop in the date, June 1st. And this is what this one's going to look like. I'm going to use accounts receivable. And from this day forward, whenever we use accounts receivable, we're going to follow it by the name of the customer. because we're going to have to go update two places, the controlling account and the subsidiary ledger. So accounts receivable and then sales. Now I'm going to come down here to the description to compute how much I should list that amount. Okay, so the list price is not what they're paying. The list price is $9,000. And because these people deal with high volume, there's going to be a 20% trade discount. So I'm going to calculate that off to the side here. 9,000 times 20%. Let me go ahead and calculate that. They're going to give me an $1,800 discount. So the net price would be the difference between those two. I'll let you guys compute that on your calculators. Remember, there's not a special account to record trade discounts in. So for your notes, this transaction is recorded at the net amount. So that's where we get our debit and our credit. I'm going to wait for a second for that to sink in. And of course, you guys are always allowed to stop and ask me questions anytime you have them. Is there anything up there that you see that you're not quite sure of, or you thought it should be done another way? Okay. Then on the next one, on June 15th, they recorded cash sales. So they saved up their cash sales and they're recording them, it looks like twice a month. And this one says from June 1st to June 15th, we had cash sales of $10,200 plus sales tax. Okay, note this. On the test, I would expect you guys to be able to calculate the sales tax. Okay, they do not have to give it to you. So the first thing I want to show you is how they came up with that 816. They mentioned that there was an 8% tax rate. So the way they derived that, so that you're not left out in the dark on your homework, is they took that 10,200 and multiplied it by 8%. That's how they came up with the tax. So our job is to record the cash sales. Okay, so here's the shell. They got cash, and they got cash for the sum of the sales and the sales tax payable. So I'm going to go fill these credits in first because they're typically easier. They're given. So 10,200 was the amount of the sale. 816 was the amount of the tax. And so my cash would be for the sum of those two. So go ahead and calculate that. I got 11,016. We're going to record a few journal entries, and then I'll show you how to do the posting on the worksheet after we get these 4 down. Okay, next one, unless you guys have questions. That's just let me put a description. Cash sales for the first half of the month. Now I wanted to make sure that I went over live with you a credit card transaction. So I'm really glad that we're including this one because the sales on using credit cards are the ones that cause the most problems on the exam. So I want to make sure we take a look at one of those. We're going to do that right now. Okay, so here's what it says. Recorded sales for the first half of the month to customers using bank credit cards. That is key. Bank credit cards means you get cash up front, but the bank is going to take their 3% fee off the top. So recorded those credit card sales of 14,200 plus tax of 1136. You should be able to compute that if they don't give it to you. And they remind you to not forget that there's a 3% credit card expense. Okay, here's what the shell is going to look like. And then we'll go back and we'll fill in the numbers. So bank credit card transactions, you get cash up front. So I don't know how much yet, but I know if it's a bank credit card, I get cash up front. But there's also a bank fee expense. I think your book just calls this credit card expense. And then, like all transactions, there will be sales and sales tax payable if you're selling to the end user. And what I tell students is on these types of transactions, it's usually easiest to work backwards. In other words, the credits are usually the easiest ones to get. So I'm going to go back up and look up here. It said that the sale was $14,200. Okay, let me get that in. $14,200. And it said the tax was 8%. Well, I want you guys to be able to calculate that on a test. So I'm going to show the calculation. I know the author gave it to you, but I want you to get into the habit of calculating it on your own. And then here's where the tricky part comes in. Part of that the bank keeps, and part of it is left for you. That's what the debit to cash is. Now, the trick is that 3% credit card fee is on the whole thing. So I'm going to come up here to credit card fee expense, and I'm going to write down how to compute that. It's $14,200 plus the tax. Okay, so I'm going to calculate that part first. I'm going to do this on my calculator. 14,200 plus 1136 equals 15,336. Giselle, I'd really appreciate it if you could double check my math for me. That's the part that's subject to the 3%. Okay, so I'm going to calculate what the bank is going to keep off the top. And the way you do that is you add up the whole thing, just like we did here, and you multiply it by 3%. So 15,336 times 3%. I got $460.08. Thank you. And so the cash is for the rest of it. The cash is that same 15,336 that we just did below, less what the bank gets their grimy hands on. Okay, that's how much we get. So 15,336 less what the bank kept. Here's what I got for the cash. This is a compound entry. That means it's a transaction that has more than just one debit or credit. So if I were you guys and I was doing this for a test, for example, I would always take a second to add up the debits and make sure that they balance to the credits. Otherwise, you'll be in for a headache later. And
Professor Johnson, I got 4,600
for this fee.
For the credit card expense, yeah.
Yeah, let's double check that. Did you do 0.03, Giselle?
Oh, I did 0.3. Okay.
Okay. Yep. What you just did, I'm actually glad you did that because that's a very common mistake. So I'm glad you did it because it happens a lot. We want to make sure we do the 3%. And this is to record bank credit card sales. We'll do one more because it's a good review of what we covered last time. And then we'll look at posting it. But I'm going to stop for a second and see if anybody has questions, because that one, for some reason, those credit cards are the ones that cause problems on the exam. I'm glad we got another chance to look over it again. Okay, then the last one said we got a check from Sonoma Country Kitchens. You'll recall here, I'll put it in green, that they owed us $7,200. There wasn't any kind of a prompt payment discount because the term was net 15. So the last one that we're going to show says got a check in payment of that invoice. So that would be for 7,200. So let me go get the date on that. It was the 16th. We would get some cash and we would credit accounts receivable, Sonoma, can't remember the name, Sonoma Country Kitchens. And that would be for that green amount. I'm going to go grab it so I don't transpose the number, 7,200. We got cash in and they don't owe it to us anymore. Received payment on account. I would put my invoice number in there if they gave it to me. They did, 6920. And they had 15 days to pay it. No discount given because they are a wholesale customer. We already gave them a big trade discount. They just had to pay it within 15 days, and they did. So that's the first thing I want you guys to do on this problem. So we've done, I don't know, maybe a third of it, maybe closer to half. The other thing I want you to do is I want you to practice posting these transactions. And so I made a worksheet for you on the next tab over. Before I go post a couple of these, let me give you another chance to ask questions. You gotta master chapter 7, the chapter on the sales side of the house, before you go on to chapter 8, because they're gonna bounce off or piggyback off each other. So if you can do this, chapter 8 will be very easy. If you don't take the time to master chapter 7, it's hard to even go any further. We're on this pyramid, right? We're on these building blocks of this pyramid, and each level supports the next one up. Okay, so what I want you guys to do at home, I'll do the first few, but I want you to try and post these transactions to 2 things. I did this for a reason. I wanted to give you some more practice with posting to the Accounts Receivable Subsidiary Ledger. So I'm going to highlight again, kind of as a danger zone, this Accounts Receivable T account. If you touch the yellow area, if you touch Accounts Receivable, then you also need to go update the person's card. So going back to what we just did, we had a debit to accounts receivable and a credit to sales. That's what I'm going to post. A debit to accounts receivable for 7,200. I'm going to date this transaction just like we would if we were posting. So a debit to accounts receivable and a credit to sales. Let me go get that sales number in. 7,200. We always want to make sure that our debits equal our credits. More importantly for me, because this is the new part of the chapter, if you touched this yellow area, you got to do one more thing. You got to go also update the subsidiary card. So here's my subsidiary card for Sonoma Country Kitchens. These are usually listed alphabetically, so I'd be looking for Sonoma. This is an Accounts Receivable Subsidiary Ledger, so I'm going to put my 7,200 in. And if the customer calls me up right now, they owe me $7,200. And once you do that, you would go put the cross-reference in. Okay, what do I mean by that, or the post-reference? You would go over here and you would put in those 2 account numbers. So in this example, they did give us account numbers on the next page. This would be 121/check mark. It's too hard to make a check mark in Excel, so I'm going to make it with my pen. I'm going to try to. Okay. It's giving me a little bit of a hassle there. There we go. And my sales account number is 401. And back over here, whatever this journal page is, and I believe they told us in the problem it was 15, I'm going to come back over here and I'm going to put that J15 in the post reference. That post reference column kind of got cut off. Let me move this out of the way. and we'll put J15. I'll make that a little bit wider so you can see it. We've just fully posted the account. Now you could go put J15s on these other accounts as well, but the focus here is on the Accounts Receivable Subsidiary Ledger. And here's where I want the focus to be. At all times, the whole, remember this is the controlling account, the whole thing has to equal the sum of the parts. At the end of this problem, you're going to do a schedule of accounts receivable, and you're going to prove that the sum of these three customers' balances balances back to accounts receivable. Again, you got to get this down before you try and move on to chapter 8. So any questions on how that posting would work? So what I want you guys to do then is go home as part of your study time in the next couple days. Try this problem because it is a 10-point test question, and I'll send you the answer out later today. And you can check your schedule against my schedule. It's a really good review of the chapter. And again, it's important to get the concepts down before we get too deep into the buying side. Any questions?